Hey traders, today we're going to be chatting about the difference between a centralized and decentralized exchange. A centralized exchange is a structured, regulated marketplace with rules that traders are required to follow. In addition, all products have specifications that traders are obligated to trade within. What this means is, as an example, the S&P 500 has a tick value of 1250 for each tick. This is a requirement for that specific contract and cannot be altered. In addition, all orders are routed through one centralized exchange, being the CME. This allows traders to have transparency while they're trading, and you can see the volume at every contract price and level on your trading DOM. A decentralized exchange, on the other hand, compared to a centralized one, does not have as many rules and regulations. We see on a decentralized exchange that this relies on a network of participants to consolidate with the volume on each exchange. As an example of this, in cryptocurrency, we have Binance or KuCoin as exchanges for traders to operate on. This allows traders to have flexibility with their exchanges, unlike in futures. Traders in futures have to go through one exchange, the CME. But with cryptocurrency, they can choose between Binance, Coinbase, KuCoin, etc. This gives traders flexibility in fee structures and different forms of liquidity. On a centralized market, you do not get fragmentation in liquidity like you would in a decentralized one. In a decentralized market, like cryptocurrency, you will see that due to fees and other reasons, Binance may have higher liquidity or trading volumes than Coinbase, or vice versa. In a centralized market, there is one location for traders to trade at. Because of this, it facilitates higher trading volumes and reflects collective market sentiment and information more accurately. With fragmented liquidity, one exchange may behave differently than another. One exchange may see a price change before another, causing arbitrage opportunities for traders, which can either be a pro or a con depending on the circumstances. A centralized exchange has a flat commission charge per contract. For example, at EdgeClear, we may charge $3 per contract traded on the ES. This means as a trader, you would be charged $3 per contract traded. This can easily be input into your platform, allowing you to have a clear, predictable transaction cost for your trading. It also enables you to forecast pricing and plan for future trading costs at EdgeClear. However, on a decentralized exchange, particularly within Forex, you may see that fees are embedded within the bid and ask spread. This is what we refer to when we say you are trading against your broker. The broker builds in a spread within the contract, and you are required to operate within that specific spread. This is how your broker collects commissions while you trade. However, in cryptocurrency, they use maker-taker fees. A maker-taker fee means that if you are executing a market order, you are considered a taker. If you are executing a limit order, you are considered a maker. In this scenario, a maker fee is typically lower than a taker fee. These are just a couple of ways that commissions are structured differently between a centralized and decentralized exchange. In conclusion, a centralized market offers a structured, regulated environment for traders, promotes transparency, liquidity, and efficient price discovery. Thank you all for joining this EdgeShort. Hope to see you again soon.